sarcastic.com. I'm Mike Conlon. I'm one of the senior instructors with the courses. Welcome to today's blog. Today's blog is entitled, What Have We Learned? Happy anniversary. 1 year ago today, the collapse of Lehman Brothers kicked off the economic death spiral that nearly took down the world's economy, and it caused the U.S. government to take unprecedented action to prevent the Great Depression 2.0. Since that time, we've been through a lot, and now that the banks have been stabilized, what should we expect going forward? Well, that all depends on whether or not you believe we have learned anything from this once-in-a-lifetime fiasco. While it's comical to watch the CNBC Zoo crew play Monday morning quarterback and speculate over what might have been, I think it's more productive to identify some of the sins of the past that brought us to the edge of the cliff and what has been done to ensure that this never happens again. Let's have a look.
As always, be sure to check out the written blog at www.mywealth.com/blog. Okay, now no discussion of the credit crisis, can begin without talking about credit default swaps. All right, now one of the things that we need to talk about is that credit default swaps, otherwise known as CDS, should be regulated. All right, Warren Buffett referred to them as financial weapons of mass destruction. Okay, and the unregulated nature of this market was a major factor in contributing to the financial meltdown. All right, increased financial regulation was a top priority of the current administration, yet here we are, 1 year later, with no new regulatory reforms. Okay, because what happened with the CDS market is that people were allowed to over-speculate and to over-leverage their accounts, and the banks took these massive losses on these toxic assets, which helped perpetuate the massive death spiral that we saw in the past year. So credit default swaps need to be regulated. Okay, we just talked about it, but excessive leverage needs to be reduced even further. Okay, some of these banks were operating at many times their balance sheet. Okay, and then once the losses came in, they weren't able to handle them. All right. Now, this is a reason why that they need to look at excessive leverage and how banks operate. Okay. You talk about some of these banks that are considered too big to fail. Okay. And these are also banks that have investment arms. Now we talk about there used to be something called the Glass-Steagall Act, which was repealed back over a decade ago. And basically, what that did is that separated commercial banks from investment banks. Well, since they repealed that, commercial banks have been allowed to operate as investment banks. Okay, and this is one of the reasons that all of this excessive speculation was allowed to take place. And when these banks did get into trouble, okay, then it really hit Main Street, because now you had banks that were going to go under, that were holding people's life savings, that had no interest in ever being involved in these markets, but were by proxy and didn't really know about it. Okay, so that was one of the reasons why these banks had problems. All right, so what's happened so far with this market? Well, not much, okay? All that's happened is the banks have halted their lending. They're basically not lending to anybody. They're starting to reduce leverage, but they're sort of keeping the money to themselves to be able to make up for some of these massive losses they took, okay? And then they, pawned off their toxic assets on the government, which by proxy is you, the taxpayer. So we're all sort of paying for it, all right? So, I don't know if this is actually discouraging, this sort of behavior, but, if you can sit there and you can keep the gains and have somebody else take your losses, that sounds pretty good to me. Okay, next thing we want to look at is executive compensation. Okay, it needs to be reformed and bad behavior not be rewarded. All right, now this is a symptom, and it was also part of the problem that you had, is that you had greedy bankers who were willing to take this money, take these excessive bets, okay, and that if they pay it out, they'd be able to pay themselves handsomely. All right, now you see that just recently Goldman Sachs announced, we have record earnings and we made all this money, so we're gonna hand out these record bonuses to our employees. Well, guess what? They took TARP money. They took money from the taxpayer to stabilize their situation. Okay, and part of the bailouts, particularly the bailout of AIG, actually helped them make those gains. So if they don't make those gains, they don't get these bonuses if the government doesn't help bail them out. So, is that really fair? Well, obviously I don't think so. But at the end of the day, everyone's starting to catch on to this. If you notice now, the G20 is now talking about that in their meetings. So that they're saying, hey, we need to do something about executive compensation. All right. So in the written blog, I'm being a little bit facetious here and a little bit sarcastic, but at the end of the day, something needs to be done about executive compensation. Okay, and the last thing that needs to happen is interest rates need to return to sane levels to prevent bubbles. Okay, basically before we had the financial collapse, we were operating in a ridiculously low interest rate environment. Okay, and this allowed bubbles to occur. You have to talk about the housing bubble, the real estate bubble. Everybody and their brother took out a mortgage, bought a house, whether they could afford it or not. So that became a problem because now people felt like they were entitled to these things. You were entitled to own a home, you were entitled to a luxury vehicle or a plasma TV or whatever the case may be, and the banks were just handing you out money. Because interest rates were so low, it had to go somewhere. Okay, and this really encouraged a lot of speculation, which otherwise may not have occurred. So that's something that needs to be looked at as well. But again, this is something that hasn't taken place yet. If you look at our interest rate today, okay, it's the same, if not lower than where it was at the height of the credit crisis. So these are all things that the government needs to look at. But unfortunately, it doesn't look like anyone's done anything about it yet, so it's been business as usual so far. So anyway, going forward, we're going to see how this plays out. All right, so don't wait. Get in a course, get educated. Come to www.mywealth.com and learn about how these government actions can affect your investments.
So what have we learned from this mess? After all, those who don't learn from the past are doomed to repeat it. First thing we learned is that financial reform is just a myth and nothing more than a populist rallying cry to help politicians get elected. Once in office, they can continue to profit from the banking lobbyists who reward them for their inaction. Right, next thing we learned is that it pays to be a big bank. Okay, you get to keep all of your profits and distribute it to your employees in the form of bonuses, okay, and then have the government and taxpayers pick up the tab when you lose. Right, and the last thing we learned is that having excessively low interest rates never leads to inflation or speculative bubbles, okay, and that the government always follows the best course of action. Okay, so as you can see, by learning from the lessons of the past, we can be sure to avoid another financial crisis in the future. Okay, just trust in those in Washington, D.C. and Wall Street, and that they're going to have your best interests at heart. Okay, I'm serious. There's no kidding. No sarcasm here. Okay, so to learn more about investing, please come check out our courses at www.mywealth.com. I'm Mike Conlon. Thanks for being with me, and I hope to see you in those courses.